Welcome to the November edition of Fixed Income Outlook, where we are going to talk about how debt is a hidden winner. Now, when we look at debt or fixed income as an asset class, it really doesn't get the kind of attention or importance that it should have. This has largely been clouded by the fact that debt is taxed at a much higher rate than equity or other instruments, and also the fact that returns are never really wow when it comes to this asset class. When we look at an asset class that doesn't deliver amazing returns but is reliable and dependable, we need to think more about the qualities of the asset class than the kind of return expectations that we're setting. So while we get into this month's outlook is going to focus on the RBI minutes which came out, the Fed policy that was recently announced, as well as how debt has performed in the last 1 year. So let's get into it. Point number one is with the RBI's minutes. When we look at the RBI's announcement, we know that November isn't a policy decision-making month and we're scheduled to have our next policy meeting in December. But when we look at the minutes, what we're really going to see here is that a lot of the committee members, while they chose to keep the stance neutral and to keep the rates where they are, you are seeing some shift in sentiment and some advocacy to take the stance into a more accommodative framework. The idea behind keeping the stance neutral from the governor as well as the deputy governor is that changing the stance kind of signals what the future course of action is going to be, and with the level of uncertainty that's there, signaling something as a surety could create the wrong kind of expectations in the market. Moreover, being in a neutral stance gives the RBI the flexibility to act in either direction. But increasingly, with inflation data as well as the pressures to growth that are mounting, it's likely that more policy room is open for interest rates to go lower. This brings us to the second point, which is with respect to the Federal Reserve's announcement. When we look at US macro data, you are seeing more of conflict between the unemployment numbers and the inflation numbers. So unemployment numbers, while they are low, are still inching up, and inflation numbers have been closer to 3% than the Fed's 2% target. The shift in terms of attention has moved from inflation management towards unemployment management for the Fed, and this is why you're seeing the Fed lower interest rates even as inflation is not close to their target level. More importantly, the government shutdown has created some kind of uncertainty around the data that the Fed has been working with. So this adds to the kind of gray area and decision-making space that the Federal Reserve is in today. Keeping all of this in mind, the Fed has moved in its trajectory as far as interest rates are concerned by choosing to lower interest rates and prioritizing labor market pressures over inflation pressures. Where will this lead us? I think we also have to be in wait and watch mode, just like the Fed, to see how this will play out. There are a lot of moving parts. We don't know whether inflation is transitory, whether the labor market pressures are also transitory, or how growth is going to be impacted, because there is an element of slowing down in terms of growth from government shutdowns, but you're also seeing a more resilient market than expected despite all of this. So all these variables are interesting to track, and we'll look at how that plays out as time passes on. This brings us to the third point, which is how has fixed income actually performed in this year? Now, many of us have seen just a 6 or a 7% return from our investments, whether we're looking at money market, gilt, or corporate bonds, or any of the other categories. So this in and of itself doesn't seem like a very impressive number. But if we look at how the index, particularly a large cap index like the Nifty, has performed in the last 1 year, those returns have also been sub 6%. So for an investor who didn't have to deal with the volatility and the drawdown of, say, September 2024 to March 2025, fixed income has delivered a much safer, stabler return profile for that investor. This is why looking at the relative merits of an asset class and not just the absolute numbers in terms of the returns that they deliver could be the winner for your portfolio. So with that, think about how you want to position your portfolio for an environment that has more uncertainty and a lot of question marks about where policy rates are heading, and see whether you want to take a more defensive stance, which could work out both from a quality as well as a return perspective. So with that, I'd like to leave you with the thought of how you'd like to position your portfolio in an environment of more uncertainty and in a context where fixed income is delivering returns on par with equity. If you have more questions about asset allocation or what you should be doing with your investments, reach out to us at 9500 27285.